In June 1995, Jake Ellington was working out the financial details of a tentative plan to build an extension onto his warehouse. He was concerned about what source of funds he should use in order to raise the $100,000 required for construction costs. That is why we, Group 1, will be helping Ellington Industrial Supply Corporation with their financial concerns. On today's agenda, we will be covering industry and company overview, owner, competition, historical trends, income statement, balance sheet, ratio analysis, and we will conclude off with our proposal. I will begin by talking about the industry and company overview. Ellington Industrial Supply Corporation, also known as EISI, was a distributor of machine tools, maintenance parts, and related equipment in Lakeside, 100 kilometers north of the metropolitan area, and situated on a large lake. Lakeside was the largest and fastest growing industrial center in its region with a population of 55,000. In addition, it served the surrounding farming communities and summer cottage trade. The customers of EISI were mostly industrial maintenance departments, but there were also some high-margin retail businesses, partially from the farmers in the surrounding area. Moving on to the owner. Ellington purchased the business from its previous owner, Mr. Hudgens, in February 1992. As part of the purchase agreement, Hudgens took a note payable from EISI. By 1992, Ellington had already gained wide experience in a series of jobs. He had worked for a variety of different companies, including one of his current metropolitan-based competitors. During those years, however, he dominated by a persistent ambition to operate his own business. His first personal venture was a retail hardware store in Riverton, which he sold when he acquired EISI. Ellington felt pleased with the progress his company had made in the 3 years since he purchased it. He had enjoyed considerable success in building up sales. His confidence was such that, in August 1994, EISI purchased its rented facilities when the landlord offered the property to EISI at what Ellington regarded as a very attractive price. By June 1995, monthly sales volume averaged more than $100,000. Ellington was also proud of the company's reputation for dependability and integrity. He believed his success was due largely to the personalized service and engineering advice he offered his customers. He also realized that an important factor in attracting new customers and building lasting customer relationships was a success in obtaining exclusive rights to handle the products of some of the better manufacturers. Maintaining good supply relation with those manufacturers who granted him exclusivity was a key element to the future success. On to the competition. Until late 1994, EISI had been the only distributor of machine tools and parts on Lakeside. Competition had come up from salespeople operating from out-of-town warehouses. In the fall of 1994, another distributor started up an operation in Lakeside. Ellington believed, however, that the new competitor would not conflict directly with more than a small part of his business because of the exclusive distribution rights EISI held and its specialized products. This new distributor also did not yet have the reputation for dependable service that EISI had earned. On to the future. Although market information was limited, Ellington thought that EISI had about 35% of the machine tools and equipment market in Lakeside and the surrounding region. Given the existing market potential, he believed sales could not increase beyond $2 million without expanding EISI's geographical market area. For the next 2 years, he projected probable sales of $1.4 million for the year ending January 31st, 1996, and $1.6 million for the year ending January 31st, 1997. However, he felt sales could fall as low as $1.3 million and $1.5 million for the fiscal years 96 and 97, respectively, or go as high as $1.6 and $1.8 million.
The problem. So in June of 1995, Ellington realized that his space was getting tight. His major concern was that the facilities would not be able to handle any significant increase in inventory on hand. So with this concern, he wanted to add a warehouse extension. So this would keep him maintaining his reputation of high standard of service and delivery. One of his top priorities was to reduce the age of their accounts payable to 60 for the year end. If he failed to do this, he feared that some of the company's exclusive distribution agreements would be in jeopardy, which would be devastating to the company. So, he needs to figure out the amount of money needed for the extension and the source of those funds. So in simple terms, he needs to figure out his financing. So he has some options, four to be precise. Option 1, he could borrow from a bank or private lender. Option 2, he could selling shares to a local investor. Option 3, equity financing, even though he felt that he would not get enough for the shares because he thinks that his hard work will pay off within the next year for increased profits. And there's option 4, they could generate their own shares. So as you can see, he has four very different options. It is critical that he picks the best one to benefit the company.
Hi, my name is Clay Kranak. Next, I'm going to be talking to you about the cash flow statements. We used the indirect method here. As you can see, in 1994, the net income was negative. Also, the working capital was negative, which is not good. But what is good about this is that in 1995, it improved in both categories. The cash flow from operations actually went from negative 36,000 and change in 1994 to positive 49,000 and change in 1995, which is great. Another thing to note is that when you look at the cash flows from investing, it went from a negative number in 1994. However, in 1995, it was up about 60,000, and that is due to them buying the building. However, in both years, they both had negative cash flows. But with that said, one of our recommendations for Jake and his company is to look at getting an operating line of credit because his cash balance is so low. We expect Jake's cash flow next year to be a bit lower than it is in 1995 because he plans on lowering his days payable, which actually is not good for cash flow. Another thing to note is in 1995, the cash flow from operations is positive, which I said earlier, but we expect that in 1996 and 1997. If he continues to work at the pace he is now, we should continue to see him growing his company. However, we do think that he needs to be a little tighter with his receivables, as that is not good for cash flow. As he continues to grow his business into the future, it'll only start to expand his cash flow from operations. In conclusion, what we have found is that Ellington Industries is cash flow positive from operations. They will need future financing to meet short-term needs, and they will also need financing for long-term growth. The last conclusion we came up with is that their cash balance is depleting, which is not good.
Hello, this is Nick. I'm going to talk about the projection that we made for Ellington Industries. We made these projections off four key assumptions, which were that inventory would grow with sales at the same rate of the 3-year average. Rent will be zero since Jake recently purchased his building and he wants to expand into a building that he will own. The interest rates calculated in Exhibit 4 of the case will be as stated, plus the extra $100,000 that we will need from the bank will be included as a mortgage the same way the previous mortgage is listed in Exhibit 4. And we used admin expenses since they're more fixed in nature and they didn't grow over the past 3 years. We used the average of the 3 years at $13,420. So you can see through this projection that, like in 1995, the company will be profitable and will be making money. As Clay said, the cash flow is negative, but the cash flow from operations is positive, and we expect it to be positive in the future. A couple of other key things to note when looking at this projection is that the company will need outside financing since their sustainable growth rate is expect it to be less than what Jake expects the company to grow to. He expects sales growth to be, at the worst case, 25%, and at the best case, 55%. We used the middle of 35, his estimate of 1.4 million in 1996 and 1.6 million in 1997, because we feel he is going to find outside financing and grow into it, and he needs it to grow and service his clients to have the inventory in stock. Another thing to note is that the sustainable growth rate was unreasonable to use because Jake purchased the company in 1993 and had losses for the first 2 years. So the first year that he was profitable was 1995, and his return on equity was 71%, but that is just not sustainable and not even close to the industry average shown in Exhibit 3. So we feel that the 1997 numbers will be more accurate and more close to the industry average once he grows into it and he scales up his operations. As said earlier, Ellington Industries will need outside funding for short-term needs, not just for the long-term needs of expanding the business and buying a new building. They'll need $22,776 for short-term funding in 1996, $53,229 in 1997, and that is in addition to the building expansion, which you can see in the balance sheet is added. $100,000 was added to the building and long-term debt to keep it balanced, and also on the balance sheet you can see that equity grew over time, and it was due to the losses in 93 and 94 and the purchase of the company in 93. So now that they're profitable in 95, 96, 97, along with positive cash flow from operations, they should have a profitable couple of years. So there won't be much risk lending them money.
Now moving on to the ratio analysis, we first have our current ratio, which is the ability of a company to pay its short-term obligations within 1 year. As you can see in 1993, the current ratio is 2.63. This isn't a very good ratio, as it means the company is not efficiently using its current assets or its short-term financing facilities. However, it does get better from 1994 and so on all the way to 1997. Moving on to the days inventory outstanding. What this does is it is basically an efficiency metric used to measure the average number of days a company holds inventory before selling it. So as you can see in 1993, the ratio is 151.84, meaning that Ellington takes about 151 days for it to sell its inventory, which is not very efficient. But as you can see in 1994, it does get better to 101 days and then 100 days. Our projection for 1996 and 1997 is that the days inventory outstanding would be 114 days and 119 days respectively. Next, we have the days sales outstanding. This measures the average number of days that it takes a company to collect payment after a sale has been made. Generally, a DSO under 45 days is considered excellent, but as you can see, we are far from that. In 1993, we have a DSO of 105 days. It goes down all the way to 74 days in 1994, which is great, and then it goes up to 93 in 1995. We project that it goes down again to 78.12 days, and then in 1997, it goes up to 88.47 days. Moving on to the days payable outstanding. This ratio indicates the average time in days that Ellington takes to pay its bills and invoices to its trade creditors, which include supplies and vendors to other companies.
In 1993, we have a DPO of 104 days, and then it goes down to 90 days, and then up again to 124 in 1995. We project that it goes up to 130 days and then down to 120. This could be somewhat of an advantage to Ellington, as it can then use the unpaid cash for a longer period in short-term liquid investments. However, this could also irritate vendors and they may increase prices. Now on to return on assets. As you can see in 1993 and 94, our return on assets are negative. This is because our net income is negative. But in 1995, we were profitable, so we have an ROA of 5.5. We project that in 1996, it goes down to 3.71% and then down again to 2%. The next ratio we have is return on sales. As you can see in 1993, our ROS is negative 6.10% and negative 1.2% in 1994. This is because we weren't profitable those 2 years, but in 1995 it is 2.8%. And we project that it's going to go to 2%, and then in 1997 it's going to be 1.02%. Ellington's ROS is significantly low, mostly due to cost of sales and total expenses, which take a huge chunk of the profit. On to gross profit margin. It measures the percentage of revenue that exceeds the cost of goods sold. In 1993, the gross profit margin is 30.7%, and then it goes down to 26%, and then in 1995 it goes up to 28%. We project that it'll go up again to 31.8%, and then down to 26.1%. Next, we have our debt to equity ratio. As you can see that our ratios are extremely high and super unhealthy for the company. The next ratio is the interest coverage ratio, which indicates how well the firm's earnings can cover the interest payments on its debt. In 1993, we have 10.5 times, and then it goes up to 14, then 17, then all the way up to 24.8, and then down to 16.7.
So in conclusion, our proposal for the bankers will be the $100,000 construction loan we'll need to expand our facility, the additional operating loan that we'll need to cover our short-term needs, and we'll be looking at other private lending opportunities as said in the case, because there's other options, and we may need to get more money from shareholders to help please the ratios of the bankers. If anyone has any questions or wants to assess the other options, you can let us know and we'll provide the information for you. Thanks.